It does. We've gotten a lot of progress in the last 6 weeks as we've seen the yield on the 10-year come down from 5 to 4. We've added a lot on the valuation side. Seems like we're fairly valued here rather than undervalued. Need a lot of progress next year on inflation and Fed talk to keep holding those gains in valuation. So I think we're sort of at the end of this phase of the Fed rate cut cycle, or Fed rate cycle, excuse me, flipping from hikes to cuts. And there I am getting ahead of myself too.
Right. So how are you advising your clients to position heading into next year? Because you were mentioning to me earlier that you felt like what has transpired over the past 7 weeks, you were thinking was going to actually take about 6 months to happen.
Yes, I do think it makes next year a bit more challenging. We've compressed a lot of gains into a short period of time. The earnings picture still looks reasonably encouraging for next year. So while the street's at plus 11 or so, my forecast is for around 6% on the earnings side. Okay. I'm not really looking for any valuation progress next year. We've had that in the last 6 weeks, and that probably isn't going to happen next year now. But that still sets the stage for a pretty decent year of mid-single digit returns driven mainly by valuation. And maybe when we get to the end of the year, we're starting to be into the Fed cycle and can get a little more clarity on the outlook beyond that.
Now, Jess, she won't admit to it, but she's owned the Magnificent Seven. She's been long those stocks, so she's just going right to the bank. Me, on the other hand, I have not. What do I do here? Do I chase them into 2024? Do I try to find some of the sectors that have not performed? How do you think about where to go in 24?
The likely scenario in my mind is that the sevens still continue to keep pace, driven mainly by the earnings side. They've got strong earnings potential. That should continue. But small caps will catch up. They've been out of favor for a long time. There's a lot of valuation pressure. That's closed the gap a bit in the last 6 weeks, but I think still more room to go. There are a lot of segments within small cap, too, that have been pressured a lot by the rate cycle. So as you have an easing rate environment, some of the financing concerns are taken off of the table there. That's probably beneficial for margins, and the small cap side who tend to carry a bit more debt. So I'm not really afraid of the seven here. They'll continue to carry their own on earnings, but the rest of the market will catch up a bit more.
How do you view financials?
Yes, that's an interesting and challenging sector, but I think the same as the small cap space.
It's also very broad because you have the bigger banks, you have insurers, and then you also have fintech in it that was not originally in that sector, but got moved over because of the GICS changes in the spring in the S&P 500.
I think a lot of that nuance will be super interesting next year. We've had this easy knee-jerk reaction of lower rates, good for everybody, especially good for financials. And in my mind, the story of 2024 is going to be a stock-picking story, a nuanced story of not just sectors, but industry groups, and not even just industry groups, but individual companies and how they're navigating the challenges of a slower growth environment, which frankly is in front of us. So they have to be paying attention to margins.
How about energy here? We've seen a lot of volatility in the price of crude oil across the globe, supply, demand, all the geopolitical issues here. Is that a space that you like into 2024, or is that kind of had its run? Because it's been a sector that everybody forgot about for a decade, it seemed like, and then it's just been really performing well over the last couple of years.
It has been. It's hard to see an environment where those prices continue a lot higher absent more geopolitical risk. Again, just on the basis of a slowing economy. So globally, Asia had been a real powerhouse of growth. That slowed down. U.S., they'd had a massive rebound, of course, in terms of growth. But next year, with a backdrop of probably 2% economic growth, hard to see a lot of upside pressure on commodities next year.
How are your clients feeling right now?
I think they, like most of the rest of the world, are feeling a bit surprised at how quickly the last 6 weeks unfolded. It was sort of very easy back in October to look at the year and say, it's been an okay year, but there are a lot of things that have been lagging. And a lot's happened in 6 weeks.
Do any of them have FOMO from the past 6-7 weeks?
I don't think so. We've done a pretty good job, I think, of keeping clients invested, and our view for most of this year had been relatively optimistic. So we hadn't been in the bearish camp. We had been in the optimistic camp on the year on the basis of the progress that's been made in inflation and economy, mainly on the economy. A lot of folks had a really strong recessionary bias, and we have not had that. And so I think for the most part, we've kept a pretty steady course through the year and not feeling like we're missing out on anything.
How do you view the trajectory of the economy next year?
Definitely slowing. I'm not in the recession camp, mainly on the basis that I think we'll see it coming, and that sounds like very dangerous words, but with the availability of real-time data that we have and the fact that we're still adding jobs in the economy, that means economic growth. And we can debate a lot whether that's 0.5% or 2%, but it is still growth. And I think until we start seeing some signals that economic activity is turning negative, we're in a slow growth.
What are some of your favorite signals that you like to gauge? Because I feel like there's sort of the telltale signs that Wall Street likes to look at, but what do you like to use from more of an investment perspective, maybe contrarian perspective too, to see if certain things are weakening where you start loading up on stocks?
Yeah, that's a great question. We do a lot of factor work. We do a lot of work on spreads between sectors and attribution, and then tying that to where we are in the economic cycle. So just looking at rates of change on different indicators on the economy, both real time and jobs growth, and basically trying to link those two pieces together. So our story for 2023 had been avoiding recession, and we thought that would be good for earnings, and that's by and large played out. And the story for next year is sort of more of the same, but at a much smaller level. No recession, very slow earnings growth, and eking out mid-single digit gains in earnings.
How about outside the U.S.? Any opportunities there for you guys?
It's been a really tough area. Every time we and others look at it, there's that nice looking valuation gap that never seems to close. And the challenge there, I think, is growth. Asia growth has been slowing. Europe's had a really tough time generating growth. The sectors that are growth oriented in terms of generating organic earnings are really in the U.S. And so it's very hard to get excited about those areas. There are, of course, great companies that are very undervalued because they're based overseas. So there are some selective opportunities, but more of a stock picking opportunity rather than a broad-based international play.